All right, everybody, welcome to another episode. First ever three-person episode. I've got my two friends, Nick and Dave, here from Geologie for episode, like whatever it is at this point, like 13 or something. Actually, I don't know what it is. 13, call it 13. So we're a couple months in here, and I brought my two friends, Nick and Dave, the co-founders of a skincare business called Geologie. Gentlemen, how are we?
Doing great. It's nice to be
Awesome, man.
nice to be number 13.
Well, it was supposed to be like number like 8, but then you got sick, and then I got sick, and then I don't know. It happened a bunch, but Nick,
I overslept.
oh, the first one, no. So back when finance operators was a thing, I tried to get Nick on because this is when the Geologie acquisition happened back in like March or something.
Yeah.
And I invited him on, and the podcast was at like 10 a.m. Central. I think you might be on Pacific or something. And dude sleeps through the 10 a.m. podcast. So actually, it's your fault. You're right.
Nick was deep in recovery at that period.
It was deep in recovery, and we'll get to that. And so everyone that's listening, so the reason that I wanted these guys on the podcast, so I think they have a very, very interesting and unique story from sort of end to end in their journey with Geologie. And so what I want to do is spend a lot of time with these guys, sort of having the floor, talking about how they came together to start the brand, and then earlier this year the brand was acquired. Where's that company based? It's like a Brazilian company, I think, or something.
They're out of Uruguay, and they have an American US based subsidiary that did the acquisition.
Okay. So yeah, Mega Labs, sort of multinational company, ends up buying Geologie after 8 years. So spoiler alert, that's kind of what happens. But guys, I want to start with just like quick backgrounds on you both. Maybe Nick, you can go first. Just kind of tell us like how you came up in the startup world and how you ended up with Geologie.
Yeah. So long story short,
It is a long story short. I'm asking you to make a very long story short.
early days of my career were in the Wall Street world. I was an equity analyst at Morgan Stanley. Post crash, I was like, enough Wall Street business, and joined a really small venture fund. And within that, ended up incubating and being a co-founder of a startup called Sidecar. That went on to get bought by General Motors. I started another one, which crashed and burned spectacularly. And I had like enough of apps, and I was like, I want to do a physical.
Sorry, real quick. Sidecar was the number 3 ride sharing company. So it was Uber, Lyft, and then Sidecar.
It was more like Uber started as a black car service. We launched the equivalent of the idea of people picking people up in their own cars. Lyft launched after us, battled it out. We could have a whole podcast on just this story.
Yeah.
And then we like kind of lost a fundraising race, and they went on.
But it was significant. I mean, like you raised money from Lightspeed, and it was like a a legit company. So you glossed over it a little bit, but it was it is a whole podcast in itself. But it's a pretty cool it was a pretty cool story. So anyway,
it's a wild ride. I mean, the stories are pretty endless. But the genesis of Geologie is I was working for GM at the time. And I was working on autonomous vehicle commercialization. And so I went around kind of all over the world with GM to like kind of check out their capabilities. I was in Korea, didn't want to come home empty handed to my girlfriend, brought her some fancy Korean skincare products. I did the whole thing with her. And I was like, whoa, like, why don't I do that? Like, why don't I take care of my skin? And, my time wrapped up at GM, and I was thinking about what to do next. And I brought these Korean skincare products to on a motorcycle trip, did them with some friends. They loved it. And I was like, I'm going to start a skincare business for men. And that's how it started.
So it was Nick's idea. Okay.
It was.
And then and Dave, you mentioned you guys have been friends for 25 years. So take me back through your background and when you met Nick and how he convinced you to do men's skincare.
Yeah, the short story is, I mean, I lived in San Francisco like a long time ago for about 10 years. I was the second person at the Webby Awards. I built that over the first like 5 years of its existence. Then I worked in advertising for a long time before starting my own agency that specialized in doing e-commerce work. So yeah, Nick and I were friends from way back. We actually were roommates in San Francisco. in the early 2000s
Oh,
for
cool.
about 5 years before I moved back to New York and started my own agency. I had an agency doing a lot of e-commerce work. Nick actually, his various companies over the years had hired my agency for many projects. So, we we actually like to joke, like we like working together, but we have a lot of like good friends that we would never want to work with.
Yeah.
Good, because we had a lot of sort of, experiences sort of trialing that working relationship. And my e-commerce agency focused mostly on sort of beauty and personal care brands at that time. So in some fashion too. So I'd worked with a ton of the big guys, Estee Lauder, Clinique, etc. And I'd also done a lot of work for Kiehl's. So I had a lot of exposure to skincare and men's skincare in particular. And I was looking to sort of move on from that and start something else. And Nick called me, and Nick had this idea to start personalized skincare for men. I knew about men's skincare and I knew a lot about e-commerce, and I'm sort of the classic, detail-oriented COO type,
Yeah.
and Nick is the sort of classic, step on the gas all the time CEO type. And so I think for those reasons, it looked like it was going to be a good partnership. And I have to say, like, it definitely was.
Yeah.
Just sort of fast forwarding a little bit here, I think it was a great asset to our company. I think the other people in the company sort of knew that we communicated well. So there was never any like, oh, I'm going to go play daddy against mommy, as like that can happen in smaller political companies. Yeah. As we never had any of that. And, we went through the whole experience. I mean, I literally don't remember a single argument of significance that we ever had along the way. And we ended up, great friends and remained great friends afterwards. So it's kind of an interesting story, I think, just on that level. But yeah, and for us, we had worked together a bit in the past. The timing was really good. We got together, and it was also a good like merger of our respective skill sets too, with some overlap, but not a ton.
And so the brand started in 2017, 2018?
2018? Really?
2018?
Yeah.
I think I incorporated it on the last day of 2017, maybe.
Okay.
No, first day of 2018.
First day of 2018.
There's the detail orientation. Yeah, exactly.
Yeah. And we spent about a year working on it. I think longer than I had sort of hoped, coming from a software background. I was like, damn.
Oh, Nick was convinced we could launch this whole thing in 3 months.
I'm like, why did these bottles take so long?
Man, it's like you gotta wait. You end up waiting like 3 months just to like get it. It's like nothing even like, I guess there's other stuff you can do. So, okay. So anyway, so incorporated on the first day of 2018. When did you start doing sales?
Real sales, 2019, right at the beginning of 2019.
Basically, yeah. We did some pre-sale stuff for a couple months to sort of test the waters, but we didn't really want to launch into Q4. So we launched into Q1 2019.
So brand, you guys get together in 2018. Brand launches in 2019. I believe you launched direct to consumer.
Yep.
And did you guys raise any money at the beginning? I know you raised some money, but was it at the very beginning? Like, walk me through sort of like the getting off the ground phase.
Yeah, getting off the ground phase. I can't remember exactly how much I raised, but it was like a friends and family round. We didn't really do any institutional. I mean, it was several $100,000.
400. 400.
And then it was enough to sort of get going, right? It's like, all right, we need to put some points on the board. We need to get the business out there. We need to like feel out who we are before we go and try to raise like institutional capital.
Okay, so like basically like an angel round, sort of at the seed, if you will, or was it like pre-revenue?
It was pre-revenue. It was
okay.
The important thing that we did, because one of the important things is I didn't know a lot about the skincare cosmetics business. So in the course of my research in the space, I found this guy, Dr. Steve Zhu, who was our like chief medical officer, who was with us from the beginning, the whole time through the sale. And he did all of the like the formulations and gave us confidence that we were putting like a quality product out into the market. That was like really important. One of the things I found in my research, like, there were a lot of guys skincare brands, but like, honestly, most of it was dog that I wouldn't put on my face.
Yeah. I mean, I was going to say like this category is like notoriously difficult. So like my question was going to be like, what gave you the confidence? So you decide like, okay, like I did my motorcycle trip or whatever, and I raised some money. Like, how do you how did you get conviction around like entering this market with like, was it like a new type of specific product or like formulation, or like what did you think was going to be different, and like why would you ever do that?
Yeah. A little beginner's mind, Suzuki Roshi, the Japanese Zen guy who, when you don't know everything, you have this idea of anything's possible. And,
Yeah.
I had kind of done two startups. I had raised money before. So I was just kind of like, I can do this. Like I saw a thing in the market, a differentiation. And I felt like I had founder market product fit. It
Yeah.
sort of made sense for me. I was turning close to 40 at the time. I was experiencing this thing of like, oh, why don't I take care of my skin? Like that makes sense
Mhm.
that I should be able to like convey that to someone else. And I didn't really see anyone quite doing it like we wanted to do it in the market. And
I think there were a lot of good reasons why nobody was doing it. I mean, as we sort of got into figuring out what we were doing and actually making it happen, we realized how hard it was. And the more we realized how hard it was, the more we realized. I mean, I think what was really hard was the personalization system that we created, right? Like, guys don't know what to shop for. So we didn't give them any choice. You just go through our quiz. You only got one option to buy, and that was it. I mean, we didn't even sell a
Oh,
la carte
interesting.
products.
Okay.
We didn't sell any a la carte products for 2 years. I mean, after that, yes, you can go on our site, you can buy anything individually, but we literally didn't do anything. You go on our site, you can only buy one thing, your personalized regimen. That
That
was
actually
it.
makes a ton of
You got
sense. Like, just make it like brain dead stupid because
brain dead stupid. You got a 30-day trial, including 5 products, and then after that, it converted to a 90-day trial of 5 products.
Hmm.
Right. This was hard to do though for a bunch of reasons. I mean, one, there was like a real capital intensity to getting this off the ground. We were starting the brand with 10 SKUs. We had 20 SKUs. We had 10 trial SKUs and 10 full size
Yeah.
SKUs. Like, we didn't know that you just don't do that as a beauty brand. Like, we got a lot of like weird eyes when we talked to people in the industry about starting. Even our contract manufacturer that we eventually went with was like, how many SKUs are you starting with? They expect to hear a number that's like 3.
Yeah.
And we were like 20. And they were like, you guys must be crazy, but okay. Right. And I actually think that craziness kind of went a long way. And then also, during this period, Nick's working in the sort of financial model. And the good news about doing it this way was that, the 30-day to 90-day trial was going to do a like pretty significant AOV on the second purchase, the first subscription purchase, right after trial.
Yeah.
And that penciled out really well in the early days. And literally that did become the sort of backbone of the business from day zero to the time we sold it. Right. We tried a lot of other things. We did a lot of other things to increase AOV. We launched new products, all that sort of good stuff. But like the initial idea that we had for financial success in this business was born like before we launched. And yeah, subscription business was really sort of the idea of why we thought this could work, and it did work, and that always became the sort of backbone of the business.
I think Nick sent me one time like a giant box, like everything you could possibly get from Geologie, and the eucalyptus body wash specifically. This is
Yeah.
dude. This is probably 2 years later, and we still
Yeah.
get it. So like I personally really like the products, and I think that's probably a big part of the acquisition if I had to guess. But we'll get into that in a second. But what I'm hearing is that there's at least like some layer of sort of innovation on like the actual like approach to like men shopping for beauty products, where it's direct to consumer. You can't really, pick, because if like I'm a classic example of this. Like every time I go into like a retail store, I just like panic and I like run out.
Yes,
that's
exactly.
it.
Or
Panic. That's
Yeah.
that's the
And I'm
feeling
like,
I was trying to remove.
and I'm like a dude that's like in this industry, like every brand catches my eye. Like I love brands, but like for some reason, like when I need to go in and buy something, like, dude, every time I go into like a Zara, I go to Zara, on Michigan Avenue here 20 times a year, and like one time a year I end up buying something. So I get it. I personally get it. And that's an interesting angle for innovation, right? Like buying experience as potentially was it the primary innovation?
yeah,
Or
yes, personalization was absolutely an innovation that's more related to the buying experience than the product itself. On the other hand, we also did go into like every manufacturer and they would say, what's your price target for X, Y, or Z? And we would say, we have no price target. We literally just want it to be the best. We don't care if it's the packaging, the ingredients, whatever. We just want it to be the best, right? And so in that sense, we sort of did take the sort of shackles off of the budget in that way, even very, very early on, to create like literally what we thought were the best products we possibly could. And so I think we did like succeed on that level, and the products did do what they said they were going to do. The personalization system did work in the way that it was supposed to work. But yeah, absolutely. The simplified buying experience, I think, was the most important innovation for sure.
Interesting. I didn't really appreciate that before. But so okay, then what can you tell us about like early traction, right? So you make some great products. You say, hey, like we're gonna enter this market because we think that we can make it easier for dudes. Like how did it go in the first? You launched in 2019. How was 2019, 2020, 2021? I mean, 2020 was awesome for e-commerce. I mean, obviously I was running Mad Rabbit at the time and it was beautiful. So I don't know how you guys experienced that, but it was pretty good time to launch.
It was. I if I go back to the beginning, what we wanted to prove out was, can we get to second purchase from that trial to subscription with like a pretty high conversion rate? Like, are we getting 50%, or I can't remember what number we were targeting.
Yeah.
But are we getting a good number of guys
Can you
over
give me the number you were targeting? Dave remembers.
Yeah, we were targeting 1 in 3. We were targeting 33, and right out the gate we had like 60.
Oh, wow.
33%. We were targeting 33%. Right out the gate we had like 60%. I think it was like 58 or 59. It was like just cresting 60%.
And
so it was almost double what we'd hoped.
And at that,
that was good.
At that level, we were contribution margin break even on that second purchase. So
Okay.
it became like the question was, how much money can we put into the machine, and at what speed and through what channels to like kind of keep those sexy metrics.
Yeah.
I think what people may not appreciate around that time is that we were didn't know it, but we were in the middle, we were at the beginning of the transition from what, like DTC 1.0, Harry's and Dollar Club, to like DTC 2.0. So we're building this business in 2018. We're talking to everybody about what should we expect for our customer acquisition costs, right? And like, we didn't know it, but during 2018, like that whole thing was changing, and not for the better, right? So we're launching in 2019. We're talking to our growth marketing people who promised us, or not promised us, but like advised that your CAC is going to be about X, Y, or Z. And we're like double that as well. So great. Our AOV was good. Our conversion rates were great, but our CAC was like way, way, way higher than we had modeled too. So that was tricky, and we didn't really know what was going on. DTC 1.0 was so much, I think people like romanticize DTC 1.0 a little bit because CAC was so low, but they forget actually how much harder it was to do e-commerce then. Yeah. Like like Magento, literally, like it was pre-Shopify basically. Didn't have all the tools out of the box, right? So yeah, of course there was less competition online for the advertising dollars and the advertising eyes because e-commerce was just hard to do.
Yeah, you needed like an engineering team to have a website.
You needed an engineering team to have a website, right? So like we're figuring this out in 2018. So like, oh great, look, oh my God, all these tools available out of the box, great, right? But everyone else is thinking the same thing, right? And so that was sort of the central problem. And again, fortunately, we had great conversion rates and great AOV, so that papered over all of that.
So out of the gate, traction solid. Is that fair to say?
And Then we raised a real institutional round from Bling Capital. And that was probably $1 million.
$1 million.
Yeah.
But you ended up raising more than that.
We did over the course of the business.
Yeah, take us through the fundraising history. So you had the first couple 400 grand in the friends and family sort of pre-seed round. Then Bling comes in for $1 million post-launch.
Yeah. Bling and Charge Ventures, they were actually like in the friends and family. We did not have a traditional fundraising track. Technically, we only raised like a seed. There was notes out the yin yang. It was like constant. I was fundraising the entire business. Like we never had like a ton of money at one time.
Yeah.
Which sucked.
If you could go back, how would you change that approach, if at all?
It's not. Here's the thing that was really tricky. Like, I got, institutional round term sheets that were poor. Maybe not in valuation, but the structure and this and that. And I
Yeah.
was like, why would I take this? Like, is this a joke? And so, some of that just came from like my experience of raising money before. And I was
Yeah.
just kind of like, I'm doing this on our terms. And if that means I have to cobble together checks here and there to get what I want, then so be it, you know? And I guess that was just like stubbornness or being fortunate, but it also, we're going to get to the fact of exiting the business. Like
That's probably why it worked out well for you
yeah.
guys.
Yeah, because I had control of the business. I had the trust of my investors to do what was best in everybody's interest. And had I taken some of the other deals that were presented to me,
Yeah.
this wouldn't have gone this way.
Is there anything that you can share? You mentioned like structure, which is like obviously like a pretty like convoluted subject in many ways. Like, is there anything you can share like high level? Like, I mean, it sounds like you're not going to remember this, but like anything like what in a term sheet if like a founder sees it and then there's like no, like I'm not doing that.
Yeah, the important one for me, because I had been burned on this before, was there was the for us in the event of a sale, common and preferred voted as the single class. So usually what happens is preferred oftentimes has like a blocking right. They can
Yeah.
say, nope, we're not doing this deal, regardless of whether.
So you wanted that.
Yeah,
You wanted
I put it
okay.
in specifically. I said, this is,
Damn, that's smart.
yeah, we're only doing it this way. And, probably because maybe I was, a repeat founder and, had the foresight for that. And also the investors probably were like, yeah, okay, that's fair. And, not everybody can ask for that.
Yeah. Well, did you get pushback at all for that? Because I mean, I like the preferred. Typically it's any like senior equity. This is the NVCA doc, so like the National Venture Capital Association, like
Yeah.
the standard boilerplate
I
deal docs.
made some little changes to that old document.
Yeah, yeah, and so like that, but that's off market to your point. So usually it's like any senior equity, and then certainly a sale of the business. So like, did you get pushback from negotiating that term?
Yeah, I got a little bit of a pushback, but like, I was like, well, that's sorry. This is my like must have or no deal.
And did you end up giving on valuation for that?
I don't think so.
Okay.
No, I don't think.
No, I mean,
Okay, so
I would say we got pretty fair valuations throughout our raise history.
okay, so
But it took a lot of legwork. I mean, Nick was spending probably on average, I bet 7 out of every 12 months, primarily focused on fundraising. I bet on average,
That's
when all of a sudden,
crazy.
Dude, it was crazy.
yeah. So Nick would like dip back into the business,
Dude,
like
oh my
full time
God.
for like 4 months, and then we'd ramp up the success, and then he'd sort of be like, okay, I got to start dialing again, right, and holding these meetings, etc. So, I mean, he was still involved with the business, of course, during those periods, but I think it was also really, really stressful, right? I mean, whether you're raising or you're selling, you still have to be running the business and dealing with those processes, and it's super, super stressful. I mean, I think everybody, many people who are listening to this podcast may know that, but if they don't know that and they're sort of and they're thinking about that, they really have to realize how difficult that is. I mean, that's where it gets into like 12,
Dude,
14 days.
it's the worst,
Sorry.
especially in like in like technology, like it's easier. It's just a bigger capital market.
Yeah.
Well, I mean, I think one of the points I wanted to make though is I mean, I think that if we had raised more money, we would have definitely had more problems. I mean, not only with the pref stack on the way out and a whole bunch of other issues, I think we also would have just spent too much money. I mean, I think like we were sort of like I said, part of like DTC 2.0, which has ended now, was raising too much money and spending too much money, right? I think that we were we had to keep our team super, super lean because we were always pumping whatever capital we had back into either inventory or, of course, growth marketing, right? So we were launching new products. There were, our main line with 20 SKUs just to support it required that we be in stock in all 20 SKUs all the time, right? So our inventory requirements were like super real as well
Yeah.
and different than I think many brands choose. So, controlling inventory is super key. To managing cash, obviously controlling your staff spend is super key. I mean, I still think that Nick and I both agree that like there were certainly times when we like made a couple big ticket hires that we didn't really need to make. Like very few of the sort of big ticket hires we made actually worked out great for us, to be honest. And we had like an amazing team. We had, just like our retention was insane. But a couple of the big ticket hires we made like didn't really pay for themselves in the way that we thought they would in terms of like instant growth. Like I think that's also something to sort of consider. Like, Nick will have something to say on this too, but like I think when you're considering those big hires and really trying to sort of think about what kind of impact they're going to make to the business. I mean, I think at one point we hired like a $200,000 a year like retention specialist, hoping that like our retention would like basically double overnight. And like lo and behold, it actually didn't double overnight. I mean, we probably shouldn't have thought that it would make such a big difference, but I don't know. I think I think it's very easy to sort of, if you have too much money, just spend too much money. So there's something to be said for not having that much. And I think it did force us into like constant, not just financial, but like operational and marketing discipline as well. Right. Because like we were kind of riding a vehicle with like, the shocks weren't that great on it. Right. Like every bump in the road we kind of felt. Right. So if we had a shipping issue or we stocked out of something or, some big marketing initiative didn't work out in the way that we hoped. And we had a couple of those where it's like, oh, we got some like, false positive signals and we spent a bunch of money into it and then they didn't work out. And like, oh shit, we spent the money. Like, right. Like every one of those like $250,000 to $300,000 like hits really hurt for us. But it also made our organization like super strong. We're like, okay, how are we going to not let that happen again? Right. And again, it wasn't just a marketing thing. Sometimes these things would be in operation. Sometimes these things would be in finance. Right. And we actually like by the time we sort of had really built the business, we had like hardcore checklists basically across every department about things we needed to be checking on all the time. So I think one thing we did really well as an organization was we did keep it pretty lean because we had to. And we did a lot of really hard work learning from our mistakes. And I think actually I chalk this up to like Nick's leadership. Like Nick, there could be a problem. Somebody might have made a mistake, but Nick did a really good job of never making that personal and really never looking back and always figuring out what are we going to do to make sure that we don't make those mistakes again. Right. And I think that was really healthy for our company morale as well. Like we had a super tight team. They knew they could make mistakes. The mistakes were going to happen. Everybody made mistakes. But the key was we were going to learn from them in a really hardcore way. That's one thing we did really, really well that other founders need to be attentive to.
Yeah, and I think to your point about sort of like being like overcapitalized, you end up just like making lots of like silly mistakes that like you are just things that you would have never even like tried in the first place if you like didn't have the money, and it forces you just to focus in on what is working. What was the do you remember, like Dave will remember the total amount of money raised?
Yeah. We raised in equity $8 million.
Okay.
What got tricky is we took on about $3 million in debt. And that was basically, I went out to market to raise equity capital. Didn't like any of the term sheets. Got a debt term sheet from Liquidity Group out of Israel. And the whole plan was, I can take this money, I can triple the business, I can raise an equity round, pay off the debt,
Venture debt,
and keep going. We're all good. Well, that didn't happen because we all know DTC went so out of favor that and there was just collapse of DTC business. It was just like a graveyard. So I couldn't raise. So we're profitable. I'm paying down 150, 160, 100, something like that of this debt every single month from cash flow out of the business.
Oh wow.
It was like 110, 130, but it was
So
tough.
like we were like this, the business was like a rocket ship, right?
Yeah, yeah.
We're getting profitable, the thing's cranking, and then I'm like, uh-oh, there's no more money coming.
Yeah.
So instead of taking all that money that we were reinvesting back into the growth of the business, like I had to start paying down that debt,
Right.
and that was like a real tricky balancing act of like, okay,
At the same time, we're entering retail.
yeah, and we're
Yeah. So I want to let's get there. Let's get to like where was the business at in terms of like you launched with 20 SKUs, you had this like subscription opt-in sort of simple buying pattern. How did the business evolve up to the point of the exit? I think you guys were in Target at that point too.
I think this is a super important conversation about the way we sort of expanded our SKU count in our products, because I do think a lot of brands get to that point. They wonder, like, am I supposed to offer more products or not? Right. And I think that's a pretty sort of key here. And just to talk about that briefly, we were like, as we said at the outset, we only sold one product to begin with. Right. And then we offered like the personalized skincare set. Then we offered a la carte products. And then basically all at once, in about 6 months, we launched body care, which was primarily an Amazon play for us. And it was successful in that way.
was a couple years after we launched. We didn't
For sure.
6 months
Yeah.
later launch all this stuff.
No. Yeah. We launched body care. We launched hair care. And we also launched acne care as well.
Okay.
And so we had these sort of different sort of verticals to play in at that point, which was great. And our acne care line was really designed as a lower cost option specifically for retail, for mass retail specifically, right? And so that's really what sort of led the way for us into retail.
And we did that when DTC started falling apart. Everybody and their brother was on Twitter being like, you gotta be in retail. You gotta be in retail. You're dead if you're not in retail. And, after a while, you kind of start to believe that. If I had to do it again, it's kind of funky here because being in retail allowed us to exit the business. Based on the experience, would I do it again in that way? No. Like, retail can be really difficult. Like, there's a lot of things you don't understand. It's an entirely different business.
It's an entirely different business.
Yeah. And it wasn't in our DNA. Like,
yeah, exactly.
running an online business and growth marketing and all that, like DNA out the yin yang, like it felt really natural. And retail did not have that experience. But again,
yeah, it's interesting. Nick, do you think consumer apps are closer to D2C than D2C is to retail?
Definitely.
Yeah, isn't that weird to think about?
Yeah. So, that's like a funny thing about the experience that we had. It's like things that maybe felt uneasy sort of helped us, exit the business and exit successfully, right? Like, we didn't sell for $100 million. Like, it wasn't that kind of exit, but it was an exit that was, people made money. Like, we made money.
Yeah. And one of our main motivations was to sell to, what we hoped when we sort of set out on the process, to sell to somebody who could really be a massive asset to the company for retail distribution in the future, right? We had Target. We were going into our second year at Target. We can say this now because they finally did launch at CVS. We had CVS upcoming in 2026. These are sort of big deals, and without that much capital in the balance sheet, it was like we needed somebody that could really support this from both a capital perspective and an expertise perspective as well, who had it in their hand, right? So we were hoping to find a buyer with really strong chops in distribution. Obviously, we knew we weren't going to like select for that, but we also knew that we were probably going to look attractive to somebody that did have those kind of.
Okay. Let's take one step back then, and get into you guys. Why did you decide to sell the business? Were you approached? Did you have an advisor? Like, walk us through sort of that whole decision process.
So basically, it came down to like our balance sheet did not match like the opportunities for the business. And so we have these things happening, you know, we're in Target, we got the DTC business, Amazon's cranking, we're talking to like 3 other retailers. And I'm looking at the balance sheet and I'm like I could really use some more cash to grow this business. And so the pitch was literally like, we hired bankers. It's like, let's go to market. Like we are going to, we had some discussions with our current investors. We got new terms from the current investors. And
that were on the table. So they were willing to invest more.
They were willing to invest more. And it was an amount of money where it gave us a great shot with very little room for error.
Yeah.
Very little room. And so I was just like, you know what? I think I need to be honest about this and not risk the farm. Like, let's get a partner. Let's keep growing the business and we'll live to fight another day, you know? So we hired a banker, we hired Silverwood, highly recommend. These guys are not like, you know, super big, bold bracket or anything like that. Boutique investment bank, they specialize in this stuff. They were ruthless, you know, went out to a good number of people. We got several offers. It was
so when you hired them, so you look at you're looking at the business and you're like, I could take more money, but is that really the right thing to do here? You decide no, and then you're talking to these bankers. Is it clear that Geologie is a transactable asset at that point in time, or are you going to like test the market?
No, I had been talking to bankers, and you know, I think you've posted about this, like get to know bankers early.
Yeah.
So I had probably been talking to bankers for like 18 months.
Yeah.
Like, what's the market? And for a little while, the year before we sold, like nothing was transacting. It was like quiet. In retrospect, you know, I mean, we did what we did, but maybe I would have tried to sell it a little bit earlier. But we had like again, we were profitable. We had good metrics. Like it was a transactable business. We had multiple bankers that would have taken us out. Let me put it that way.
Despite the fact that it's not a $100 million business, right? And so that kind of comes back to the unique part of this story where it's like, you don't have to be huge. Like I think there's so much to M&A where it's like, so it goes both ways. Like some people think like if I get to $100 million, then I'm automatically worth, you know, 500 million or something when you could be not transactable.
Yeah.
And the flip side, you know, people think, you know, oh, I'm only at like whatever, you know, let's just say I'm like a smaller 7 or 8 figure brand. And they might think, well, I'm not at 100 million, so I'm not transactable. But in reality, like there are markets for assets depending on like everything about the asset. Scale is one thing and profitability is one thing and brand is one thing and loyalty is one thing. You know, there's a million different variables.
And you're never you're never going to know unless you go to market.
This idea that like an earlier stage brand like could get acquired, and not that you guys are, you know, super early stage or something, but like I think what's interesting is that like you don't have to be like $100 million brand, you know, to get acquired.
We're not shy about the fact that we weren't $100 million brand.
We did this start to finish in 8 years. That's like the bare minimum. That's the shortest you can do it. Like people in this space need to know that they need to be in it to win it for longer than that most of the time.
Yeah, exactly. And then like the market, like, I mean, I study this stuff for fun, obviously, and like I didn't know Mega Labs. Yeah. So like, you know, it's such a bigger universe than anybody kind of imagines. It sounds like they were pretty confident that this thing was going to trade.
Yeah.
Right. So okay.
Yeah, and I was confident that it was going to trade. You know,
and so like
where does it land? You know, like and to go back to some of the things you mentioned here, like there's a lot of factors that go into it. Like retail made a difference for us. The valuation, the preference stack, our ability to transact if we wanted to, like all of these things came together. So it's not like there was one decision that we made along the way. It was a whole bunch of different decisions that led up to this is an asset that fits into what someone is looking for. And we are able to transact because we never got greedy on valuation. We managed the cap table appropriately. Like all of that stuff matters.
Yeah. We have the right signs of like there's upside to the business, right? If somebody comes in at the right price. So tell us as much as you can about the actual process itself. I mean, it sounds like Nick was spending 7 months a year fundraising, so maybe it wasn't nothing new, but like I want to hear about like the nitty gritty, like, you know, getting into the weeds as much as you can.
Okay. I'll give you some weeds. The process is long.
How long?
It took 9 months start to finish.
Oh wow.
It is hard. Like you need to have your ducks in a row. Like this was not my first rodeo, as they say. So like from the start of the business, you know, we were very organized around everything you need to sell. And that is from like contracts with vendors, you know, how your employees are structured and their comp, your financials. Big plug for Iris. You know, you need like very clean financials that you can walk through. You need them from the beginning. You need board minutes. You need like all of these things so that when it's time to sell, you are giving a package to the acquirer that is clean and detailed and explains your business. Like you have to know your business. So when you're talking to the buyer and they're like, they point to a number that you've handed them, you need to be able to explain that number. And if you can't explain that number, you are not.
What's like an example of that?
Retention curves, gross margin changes, contribution margin changes.
Okay, so financial stuff mostly?
Financial stuff and performance stuff.
Okay.
Like why did this thing go from A to B? Explain it.
And how much time do you spend like getting that? I mean, it sounds like you guys are pretty well organized from the beginning, so maybe it's not that much time, but there's like this whole like readiness phase, kind of to your point in terms of like the 9-month timeline. Like you're not out there shopping a deal for 9 months.
No, we shopped for 1 month.
Oh wow.
We shopped for about 1 month. Maybe 2 months.
Dave?
But we started working on it in the summer. So that was like August. Basically, this sucked, but I was supposed to go to Burning Man and I was like, you know what? This deck that I've
got a plane to land. Yeah.
I need to spend a lot of time making sure that this book represents our business super well. It looks hot. We're a hot brand. And so my wife went to Burning Man. I stayed home, worked with Dave and the bankers. It took us about another month to get everything where we wanted. We went to market. We started getting bids. We decided on one, move forward, and then diligence was hard and long.
It's worth talking about that sort of upfront process a little bit. You're working super hardcore with your bankers during that period, right? So they're going to start asking a lot of the really hard questions. They're going to start telling you, hey, do you have this ready? Do you guys have that ready? And I mean, the spelunking is just absolutely insane. I mean, you have to have, independent contractor agreements going back to your first people ever, like if they ever got paid, you're going to have to produce documentation for them, right? The very expensive accountants on the buyer's side, they're going to find, the $60 that you still owe the city of New York from some tax notice in 2021, right? They're going to find all that little stuff. So that you didn't, half of it, like some things you won't even know existed. And you have to be able to respond to it really, really quickly. So the good news is like during that sort of upfront process, your bankers are going to be asking you a lot of these hard questions and giving you a preview and making sure that you sort of get a head start on pulling all that stuff together. So, the ideal state, I think, is that you're something like we were where, Nick had done this before. And from day one, we had really, really strong documentation of everything. It was filed. It was good. Like we were very, very good on that level, probably way better than I suspect most companies.
Oh man, you wouldn't believe. Yeah, you would not believe.
And like now that I've been out there and talking to companies about this, I'm discovering that they oftentimes don't have a financial plan early in there. early in their existence. I know you're out there, solving for that. They're also oftentimes just not taking care of any of this documentation either. It's just super fast and loose. So one thing I can say is, like, if you have an aspiration to sell someday, start taking care of this stuff now. Like, get it tight. It will, because things are going to move too fast later for you to like go back and try to like swim in that.
And it'll cost you 6 figures just trying to get it together.
7 figures.
In lawyer,
seven.
Yeah.
Multiple 7 figures.
That's crazy.
Because an acquisition for the acquirer is about, and the value, what they're paying for is how much risk am I taking on, and do I believe what's being presented to me?
Right.
And if there's like questions about that, boom, they're knocking off.
Yeah, and like the default thinking is that I don't believe what's being presented to me.
Yeah. And like I'm a psycho when it comes to like knowing the business and the numbers and like how well we're doing. Like, do not fool yourself with like fake metrics. Like, know whether your business is doing well or not and be able to talk about it. That's your job as a CEO. Like, people say it's to hire great people, it's to never run out of money. Yes, that's true. It's also to know your business better than anybody else on the team. The CEO has complete view across everything. And you should know what happens along the chain. That's your job. That's where the buck stops. And so like,
yeah, it's actually interesting. Like I mean, so I was in like the CFO, COO seat before. Now I'm in the CEO seat. And I didn't appreciate what you just said until, I was doing this, where it's like, there is nobody else that has the vantage point of like you have all the context.
Yeah.
You're in the middle of the data flow.
Yeah.
And if you don't
internally and externally.
Right. Yeah. Well, even if those are even separate at all, like it's all just one giant intersection of information. And it's almost like it's interesting, right? Because like even with Iris, like we will plug into people's stuff, right? And like we're the data warehouse, and like we do all the data transformation and stuff, and we give them a number. Let's say it's CAC, and they say,
no,
that's wrong. They say that's wrong. And I'm like, really? Here's the 70,000 orders that back in the 100 campaigns that back up the calculation of this number. Like it's honest. It's literally our biggest issue is that people like we present them with like more like GAAP numbers than they're used to.
Yeah.
Because like Shopify is not showing you GAAP revenue.
Yeah.
And so they look at our Shopify revenue and they look at the Iris revenue and they're like, you're wrong. And I'm like, no, you don't know what you're talking about.
And that's not. Especially in the brand world, I don't know what percentage of founders in the brand world came from like a business background, but I would guess not that many. Like I would guess a lot.
Not in this industry. Yeah, not in this industry.
Yeah, it's like they have a passion about a space and that's where it's built from. And, not all of them spent like 10 years on Wall Street, like looking at numbers all day.
Right.
Yeah, I think this is a really, really important point. I mean, most founders are coming from and doing most of the day, like work on product and marketing.
Correct.
And I think if you are one of those founders who doesn't come from a financial background like Nick does, I think, making sure that your team is really, really ready for this process, because you're probably gonna have to lean on them pretty hard. And obviously you as a founder need to get to know, or a CEO need to get to know all of that as much as you possibly can. But some of it just might not be in your wheelhouse. I mean, I guess here's just another thing. When you're heading out to market, you are going to make this deck. It's going to have to be sort of like the best deck you've ever made in your life.
Our deck was hot too.
It was good, but like, I mean, and great. Like you're going to get to put your marketing hat on for that. You're going to tell this whole story in about 10 or 12 pages about the trajectory of the brand and how awesome it is, and blah, blah, blah. And then there's going to be, after those 12 pages, going to be 60 pages of financial stuff. So, and you know what? Like every potential acquirer is going to gloss over those 12 pages and get to the other pages that are about the financial metrics of your business, because that's really what they care about at the end of the day. So I think like don't expect to go into this process and be able to and like be able to sort of sell your brand and how cool and how hot it is. Like you're going to spend very little time talking about how cool and hot your brand is, right? Your brand had to be good to impress a bunch of customers. Great. Hopefully it impressed a bunch of customers that they bought. And now your numbers look great.
Right.
You're going to spend 99% of your time in this process just talking about the details and the numbers, right? And zero time almost zero time talking about brand and how great it
Were
is
you guys
and how great
were you guys
products are.
audited?
We were not audited.
There's no way. Yeah.
We were not audited, but we had great, like I said, everything was clean, you know? All three financial statements, we had backups for everything, you know, details on inventory turn, like you name it, man. Like the I don't want to speculate on what they spent on diligence, but I would not be surprised if it crossed into seven figures.
It's so insane. Yeah.
Substantial.
Probably.
Yeah.
Probably. Maybe close.
Yeah. The legal and accounting is no joke.
And it's literally just like a bunch of like 26-year-olds that are billing like $1,200 an hour.
Yeah.
Which is like insane to me.
Yeah, and some of it,
so,
you know, some of it too, you're just like, why is this important? And you can't, you know, you just have to be like, yeah, no problem. Give us a day to clean that up. And you need to turn things around.
yeah.
And still, like, you can't make this shit up later, you know?
Is Mega Labs public?
No, it's private. They're big. I can't really reveal, but like, it's a big company.
Yeah. Okay. All right, we're bumping up on time here, but we have to get to like the close. Like, what was the close like? Is it just like sign a doc and get a wire? Is that like pretty much it, or like how did that go?
No. The buyer had some like unique kind of legal requirements, I'd say. We had a pretty big cap table, and we got normally you just get a majority of shareholders in the preferred and you're good to go.
Yeah.
We probably got 70 signatures, literally the entire cap table. So that was like a little nerve-wracking, you know? Like, hey, can we herd these cats in like the amount of time? So that was probably the most like stressful thing for me. And you know, it's getting like it's people want to close. It's been a long process. Like both sides want to do the transaction.
Deal fatigue, yeah.
But lawyers and accountants, like they get paid by the hour. So like they're lobbing stuff in, you know. Yeah. What about this? What about this? And that's when you're at this point of like the fatigue. Both sides having fatigues, and the lawyers are just trying to like get to a meeting point. And at that point, and some of this too, like the lawyers and the accountants almost take control of the deal, and that becomes difficult because
it's problematic. Yeah, I mean, you as the business owner, the business people, right? Like sometimes you have to take that control of the deal back.
Yeah.
If you let the lawyers just run with it, you know, they'll do what lawyers do.
Yeah, and I'll say there is a ton of benefit in having a representative, like having a banker, because especially when you're in like the serious negotiation of the term sheet phase of where the nuts and bolts are, because that person, it's so emotional, like, right, for the seller. You need an intermediary to have these like more difficult conversations.
Well, and your emotions are just running so high that like it's very, very hard to think extremely clearly, and it's very easy to freak out or panic. Right. And then, you know, if you talk to the banker who does this, you know, every day, and they're like, nah, man, like that's not a problem. Like it's all good. You know, it's like a bit of a sanity check too, I would think.
But in the diligence phase, when the lawyers and the accountants are going at it, that becomes a liability. So you mentioned take back the deal. Like there were a number of times where I had to reach out to the CEO of Mega Labs and say, hey, we need to have a direct conversation. These guys are like going crazy over here, you know?
Yeah, exactly. Yeah.
And so you sometimes just have to like you said, take back some control to get everything over the goal line and be like, listen, there's some confusion in this. Let me have a direct conversation with you so you can call off the dogs.
Yeah, exactly. That's it's crazy. There's always something. I mean, people don't realize these purchase agreements are. I mean, how long was yours? 150 pages.
Oh, at least.
Yeah.
At least.
And and every single page has like 4 things that are like,
It's serious shit.
indemnification.
It's serious shit.
Yeah.
You're making reps and warranties about your business of like, hey, what I'm telling you is true. And if you're lying about this stuff, or, that can pose liability to you down the road. It's not like the deal is just done.
It's not that it can. It definitionally is and will, and it's defined in the paperwork exactly what's going to happen to you if there's like the tipping bucket and like all this stuff.
Yeah, exactly. And it's not like there's we had to put some of the deal purchase price in escrow. Like Dave and we were done at the day of the sale. So like there's no. In this case, we didn't come along, so we weren't there to like explain things afterward. The fact,
Yeah.
like it was just boom, it's over. The wires go out, the checks hit the bank, and then it's just like do the things that you said in the course of the diligence process true for a certain period of time, and then escrow is released.
I think there's another part of this process too that maybe people don't really think about, right? There's the possibility that the deal might not close, right? That it could fall
At the
apart.
last
Not possibility, probability.
So not only do you have to during this whole very stressful process, you have to run the day-to-day of the business, right? That has to be going. So ideally you have a really, really great team, and we did, that was able to do that, especially when Nick and I, like for the last 2 months, were totally mired in this.
Yeah.
So that's fun. But also there's the contingency planning, right? So Nick was also managing, I don't know how much we want to talk about it, but a variety of other plans for what happens if this doesn't go through. There were other offers that we had that we could have gone back to that would have been challenging, but there were even some other contingency plans that we had. There are investors, right, that were willing to give more money. That was one, but like we hadn't talked.
Yeah, you have to have options.
But we hadn't like talked to them about that in 3 or 4 months while we were closing, et cetera. So preserving the options, I think, is really, really, and that takes a lot of work on its own too. Like
that's like rule number 1 of deal making.
Yeah.
It's like
you want more than one offer, Drew.
Yeah.
We were lucky. We had 3 offers, and we could have taken investor money, and that really helped in the negotiations. It's like, look, we don't need to do this deal. We want to do this deal. We think this is a great match. But like we had a walk away. And when you don't have a walk away, that's a very tough negotiating position to be in.
So wires go out, you guys get paid, and then is that it? It's done?
Pretty much.
God, for us it basically was. I mean, which is, I think, pretty unusual. Usually that's not going to be the case. There's going to be some period of crossover, I think, for most founders beyond that, but for us that was not the case.
So you didn't stay on at all?
No.
They didn't want you?
I think the
not even like as like an advisor or something?
Not even as an advisor, yeah. That was a choice of theirs, and
I mean, you have to be ready for a lot of eventualities like that. That's not something we really
we didn't anticipate that. We thought we were going to be plugged in for another 2 years.
Yeah.
That's not what they wanted.
So, when you head out on this journey to sort of see what happens, you definitely have to be sort of ready for anything.
Yeah. Well, so gentlemen, we're a bit over our time here. So, I want to hear just a little bit about what each of you guys are up to now, and where can people find you and how can people work with you?
Sure, cool. Yeah. So, I mean, I took a little bit of time. Like I joked that like I cleaned literally every house in the closet, or every closet in the house for 2 months. And then I got bored, started consulting with other brands again. So, I just love working in the sort of the 0 to 1 space. And we figured out a lot of things along the way, particularly as it relates to like ops, tech, finance, and started bringing a lot of AI into the company at the end as well. So, I've started an organization now called Low Key Better, because I think I know, and my team knows sort of better ways to do a lot of these things for ops, tech, finance.
Yep.
So specifically the sort of big project we're launching next year is a better way to do fulfillment. One of the 3 best things I think we ever did at Geologie was leave our 3PL and start our own warehouse, which we did in 2021. I mean, we literally cut our fulfillment costs by 80% basically overnight. I mean, we went from $60,000 a month to $12,000 a month and kept it pretty close to that, basically for the course of the company. So when I talk about that to a lot of brands in the beauty and wellness space, they all ask, how can I do that? So I've gotten enough super positive feedback on that I'm going to sort of launch this next year. So it's basically sort of a private fulfillment collective for beauty and wellness brands who kind of want all the advantages of having their own warehouse without actually owning it. So, some people, is that a 3PL? I'm like, no, because everybody, I think 3PL is a bad word. So if people are interested in learning more about that, they can go to lowkeybetter.com, and I've got an application there. Fill that out, and we can talk about how to do better for beauty and wellness brands.
Love it. You heard it here first. Low-key better. Nick, you off your couch yet?
Yes, Drew, I'm off the couch. The first 6 months was just like unwinding, letting off some steam. And I've been living.
Did you go to Japan or something?
Yeah, we went to Japan. I've been living in Mexico for going on 4 years now. So I also, all of this, running this business and selling it. I live in a small town in Baja called Todos Santos. And I am in the process of building a house. I'm helping a couple friends with their businesses. And, I have a couple ideas. I have a sickness, an entrepreneurial sickness.
Mm-hmm. You want more pain. You're not done yet, are you?
It's getting too easy here. So
yeah,
I will likely start something. But I let my
brand.
What's that? No.
Is it a brand?
No.
I was gonna say there's no way you do that again.
No. But I will say two things that I let go during the last couple of years of running this business were my mental and physical health. And before I start something new, I've been really working on getting those things back to tip-top shape, because you can only draw from that well without refilling it for so long.
Yeah. Well, it's a good lesson. Ladies and gentlemen, the founders of Geologie, boys, thank you for joining me. This is an awesome story. I'm glad I got to hear it from both the horses this time.
Good to see you, Drew.
Right on, man. Thank you for
Thanks so
having
much.
us.
Cool. All right.
Take care,
Thanks,
bud.
guys.